Merry Christmas, stackers. The shiny stuff looks dormant right now, flat-lining, like it's frozen solid. The charts are dead, volatility has left the building, and it feels like the metals market is hibernating for the year. But don't let that fool you. This quiet is exactly why it's dangerous. Markets don't sleep when risk vanishes. They sleep when the spring is being coiled tight. I'm cutting this video because tomorrow is critical. December 26th kicks off a window the pros know by heart but rarely talk about. We call it Ghost Week. If you're new to the stack and don't know what Ghost Week implies, you're walking blind into the most brittle trading environment of the calendar year. Ghost Week isn't just about low volume, it's about zero defense. The big bank risk desks are empty. The heavy hitters are in the Hamptons. Those deep liquidity pools that usually soak up the selling pressure, gone. We're left with a market on autopilot, thin order books, and algos programmed to keep the exchange running, not to save your portfolio. When the liquidity dries up, the paper market stops acting rational. Price action doesn't glide, it teleports. You get massive gaps. A single mid-size order can inflict damage that usually takes 100. The chart looks zen right now because nothing has hit it yet, not because it's bulletproof. Silver isn't napping, it's being compressed. We've got months of tension jammed into a market with zero depth. The biggest threat isn't panic selling, it's complacency. And this holiday lull breeds a false sense of safety. This silence isn't security, it is the calm before the tamp or the blast off. Coming up, I'll break down how Ghost Week sucks the air out of the room, creating liquidity vacuums, and why the white metal is a sitting duck when the silence snaps. Smash that subscribe button if you want to front-run the move. Drop a 1 in the comments to roll into Chapter 2 or a 2 if you're tapping out. To get why Ghost Week destroys accounts, you need to grasp one rule the retail crowd misses. Liquidity is the market. Forget the news, the MACD, or the pundits. It's all about liquidity. When the pool is deep, the market forgives you. When it drains, the market executes you. Normally, silver is buffered by walls of paper. Thousands of bids and asks stacked deep. If a whale dumps, that depth eats the shock. Spot price might wiggle a few cents, maybe a buck, but it stays leashed. This gives people a fake safety blanket. They think stability is natural. It isn't. It is artificially pinned by volume. During Ghost Week, the crowd goes home. The bullion banks flatten their books. The hedge funds clock out. The order book is left with skeleton crews. 70 to 90% of the liquidity evaporates. The walls holding the spot price steady are quietly dismantled while you're opening presents. This triggers a liquidity vacuum. In a vacuum, price doesn't travel. It teleports until it smacks into a wall. If there's no wall, it keeps falling or rising. That's how you get air pockets. That's how spot can crater $4 or rip $5 higher with zero warning and zero logic. Here is where the silver market gets treacherous. It is already a tiny market compared to stocks or Forex. It doesn't take much cash to move the needle on a normal day. During Ghost Week, it takes pocket change. One institutional rebalance, a fund covering a short or a rogue algo reading a headline can shove the price to levels that are mathematically impossible during normal hours. This is why paper traders with tight stops get wrecked over the holidays. The trend doesn't beat them. The volatility gaps right over their heads. Their stop loss never triggers because the price never existed at that number, it just teleported past it. Ghost Week strips the market naked, no fluff, no buffers, just raw, unadulterated order flow echoing in an empty hall. Next up, we'll see why this vacuum cuts both ways, how these gaps materialize, and why silver can rip faces off to the upside just as easily as it can flush down the toilet. A vacuum has no bias. It doesn't care if we moon or crash. It just magnifies the energy. Most stackers get this wrong. They think the rig is always down. In reality, the most violent moves are often the face-ripping rallies that happen too fast to catch. Usually, price discovery is a negotiation. Bulls push, bears push back, and we grind out a price. During Ghost Week, the negotiation ends. Sellers are gone, buyers are scared. And when someone finally pulls the trigger, there's nobody on the other side to absorb the blow. That is how you get gaps. Not from FOMO, but from a void. If a big buy order hits a thin book price doesn't tick up, it scans up hunting for the first seller. If the order book is empty, it keeps flying. You get a vertical line that looks insane but is just market mechanics at work. Silver is the perfect victim here. It sits at the crossroads of industry monetary panic and speculation. It triggers off everything war news, currency crashes, bond yields. Any spark can light the fuse, and during Ghost Week, that fuse doesn't hit a dampener, it hits pure oxygen. That's why you wake up to find spot price skip 3 rungs on the ladder. It didn't skip them. They didn't exist. There was nobody there to sell. The risk isn't just missing the boat, it's being on the wrong side with leverage. When price gaps your margin call doesn't ask politely. Stops fail. Accounts get liquidated before your broker even sends the email. Here is the kicker. Upside gaps break brains. They force panic buying and FOMO at the top. That is how the bullion banks transfer the bag from strong hands to weak hands at the absolute worst time. In the next section, we'll check the receipts and show why holiday weeks have historically been the launch pad for silver's most legendary runs. If you think Ghost Week is a conspiracy theory, look at the charts. Some of the most violent moves in silver didn't start during prime time. They started when nobody was watching. Holidays, dead volume, empty desks. That is the breeding ground. Rewind to Christmas 2010. Silver was already heating up. Sentiment was frothy. Indicators screamed, overbought. The banks told everyone to cash out for the year. The sheep listened, they sold, and went skiing. But in that dead zone between Christmas and New Year's, silver didn't tank. It floated up. It started as a creep, then turned into a strut. When traders logged back in come January, the price was already gone. That quiet drift morphed into a panic buy, and by April we were knocking on $50. The fuse wasn't the rally, it was the holiday silence. We saw the same movie in December 2020. Thin markets, no players. Silver was bouncing off the crash. During the break, the positioning flipped, price started climbing with no resistance. By January, we had gaps. Momentum went vertical. The dead zone became the launch pad. This matters because markets rhyme. When the liquidity evaporates and the suppression machine is unmanned, silver's natural direction is up. It takes energy to hold this beach ball underwater. When they let go, even for a second, it surfaces. But the setup today isn't a rerun of 2010. It is far more volatile. Back then, the COMEX vaults were stuffed. If price ran hot, banks could flood the market. Today, that buffer is razor thin. History isn't just waving a red flag about Ghost Week. It's telling us that holiday moves in silver often dictate the trend for the entire year. Next, we'll cover why this time is different might actually be true, the structural cracks, and why physical inventory is the only metric that counts right now. The game changer this time is one word: inventory. Past cycles were driven by paper speculation. This one is driven by physical scarcity. That changes the math. Speculative rallies can be shorted. Scarcity rallies. You lose control. Before the vaults were the shock absorbers. When spots spiked, people sold their stacks and metal flowed back to the refiners. Supply rose, price cooled. That mechanism is broken. Metal isn't flowing back in at these prices, it's draining out. That is a structural failure most paper traders don't comprehend. When registered stocks drop while price is high, the alarm bells should ring. It means buyers don't care about the premium. They want the physical metal. These aren't day traders. These are whales securing supply because they smell a shortage. Once that silver leaves the vault, it can't be rehypothecated. It can't be used to short the market. It is gone forever. This establishes what the pros call a concrete floor, not a technical support line on a chart, but a structural reality. Spot price might take a violent dip, but it can't stay down because physical stackers immediately sweep up the supply. Every tamp becomes a flash sale for those who missed the boat earlier. The market stops asking if silver is too pricey and starts asking if there's any metal left to buy. Now throw Ghost Week into the mix. Order books are drying up just as the physical vaults are emptying out. That's a volatile cocktail. Bullion dealers and market makers need actual metal to hedge their paper bets. When that inventory vanishes, their power to suppress the price collapses. They stop dictating the terms and are forced to scramble. That's how the feedback loops kick in. The price climbs, forcing them to hedge. That hedging drives the spot price even higher, which triggers another round of covering. Without physical inventory to act as a release valve, the system starts feeding on its own panic. The trap for traders is misreading the pullbacks. A dip in this environment isn't weakness, it's just stress moving around the system. Weak hands who sell out of fear often find themselves locked out with no chance to re-enter the position. In the next chapter, we'll link this physical tightness to the derivatives casino and explain how gamma mechanics can turn a quiet session into a vertical moonshot without any warning. When the physical market tightens, the pressure doesn't stay in the vaults. It bleeds into the derivatives market, and that's where the moves get violent. Futures and options are built on the lie that supply is always available. When that assumption breaks, the paper market starts chasing a reality it can no longer manipulate. The options dealers are central to this game. They sell call options thinking they can hedge by buying futures if the price runs. In normal times, with plenty of liquidity and silver bars, that works. But during Ghost Week, with thin books and vanishing supply, that hedge becomes a ticking time bomb. If silver punches through key strike levels, dealers are forced to buy futures just to stay neutral. That buying drives the price up, triggering even more mandatory hedging. It's called a gamma squeeze. It's not driven by bullish enthusiasm, it's driven by forced covering. The market isn't choosing to go up, the structure is forcing it. Add low liquidity to that fire. Normally, hedging pressure gets absorbed by plenty of sellers. During Ghost Week, the sellers are gone, so every forced buy order hits like a hammer. The price doesn't climb, it gaps. Each jump increases dealer exposure, demanding even more buying. That's why upside risk during the holidays is so often ignored. Traders are trained to fear a crash, not a squeeze. But a squeeze is far more lethal to accounts caught on the wrong side. They happen faster, they ignore all logic, and they leave you with zero exit strategy. At the same time, the algos amplify the chaos. Many systems are coded to chase volatility and new highs. When silver enters true price discovery, those bots stop fading the rallies and start piling in. They don't care about value, they follow the signal. In a thin market, that signal chasing turns into pure acceleration. What looks like market excitement on the chart is often just mechanical stress snapping. The market isn't celebrating a rally, it's breaking under the pressure. In the next chapter, we'll look at why standard indicators like the RSI fail here and why traders who worship them often sell their stacks right before the biggest leg of the move. This is where traders make their most costly error. They see familiar indicators flashing red and assume the market has to obey. Overbought, extended, unsustainable. In a market stressed by physical shortage, those signals are meaningless. Tools like the RSI are made for balanced markets where buyers and sellers barter. But when liquidity is gone and supply is tight, the negotiation ends, the price just moves. An overbought reading doesn't mean exhaustion, it means the pressure cooker is whistling. Silver has played this game before. In every major bull run, the RSI hit extreme levels early and stayed there way longer than anyone thought possible. The folks who sold or shorted because of a chart indicator weren't being prudent. They were betting against the structure. Right now, silver is in price discovery mode. There is no historical resistance overhead. More importantly, there are no bag holders waiting to sell at break even. Everyone is in the green. That removes the selling pressure that usually slows the train down. When the sellers disappear, the pullbacks get shallow and the recoveries get violent. The market doesn't wait for a confirmation signal. It runs until something physically forces it to stop. The algorithms spot this instantly. Once volatility expands and new highs are printed, the breakout systems go live. They don't care if the metal looks expensive. They only respect momentum and structure. In a thin market, that response becomes rocket fuel. That's why trusting indicators during Ghost Week is a quick way to get wrecked. A pause looks like weakness, and then the price gap's higher before logic can even react. In the next chapter, we'll focus on survival. How to navigate Ghost Week without getting shaken out by the volatility or wiped out by leverage. Ghost Week isn't about predicting the top, it's about survival. Being right means nothing if your position gets liquidated before the payout. This is where veteran stackers separate themselves from the tourists. When liquidity vanishes, the market stops respecting precision. Tight stops, heavy leverage, and short-term bets become death traps. Price can swing several dollars in seconds, not because the fundamentals changed, but because an order hit an empty book. It feels irrational, but structurally it's normal for this environment. The biggest mistake during Ghost Week is getting cocky. Traders see a narrative and think they need to max out. In reality, the better the setup, the less leverage you should touch. Volatility isn't a bug, it's the entry fee. If your stack can't handle the swings, you don't deserve the gains. This is the week for flash spikes. Sharp drops that last seconds before vanishing. These aren't trend changes, they are liquidity hunts designed to clear out weak hands. Over-leveraged traders get liquidated at the absolute bottom only to watch the market recover without them. The right move is restraint, smaller size, fewer trades, wider stops. This isn't the time for scalping pennies, it's the time to let the structure play out without interfering. Ignore the intraday noise, watch the behavior, not the candles. Survive the chaos first. The real signal arrives when full liquidity comes back online. In the next chapter, we'll look at January and how the first real trading session shows if this is just noise or the start of the big one. Holiday action creates distortion. January brings the truth. That's when the liquidity returns and the market has to show its hand was ghost week, just random noise or the start of a structural repricing. The first full session of the year is the key. That's when the hedge funds and bullion banks log back in to check their risk. If silver holds the line or pushes higher on real volume, that's your confirmation. It means the move survived contact with big capital and wasn't just a holiday glitch. A lot of traders freeze up here. They're scared to buy strength and wait for a perfect dip that never comes. Strong markets don't give you comfort. They pause, then go. A clean break above the ghost week range backed by volume isn't exhaustion. It's acceptance. Volatility at the open doesn't mean failure. Early January often brings one last shakeout. Weak hands fold, stops get triggered, and the big players absorb the supply. Watch the response. Does the price snap back? Does buying return instantly? That tells you more than the news. This is also when fear turns into FOMO. Managers who sat on their hands during the holidays suddenly face performance pressure. If silver is the only asset moving capital flows into it, out of necessity, not belief. January isn't about guessing. It's about watching. See how the dips are treated. Watch if resistance fails instead of holding. That behavior tells you if the market is gearing up for a run or running out of steam. In the final chapter, we'll tie it all together and turn this setup into clear lessons and disciplined guidance for the months ahead. Everything we've covered points to one thing. This isn't a normal market, so don't trade it like one. Ghost Week isn't the main event. It's the transition phase. It's the pressure cooker where structure gets tested before the direction is set. Forget the excitement and fear, focus on discipline. The lesson is simple but brutal. The market doesn't pay you for being right. It pays you for staying solvent long enough to be right. Scarcity tight vaults and fiat policy all point one way for silver. But the road there won't be smooth. It'll be volatile, emotional, and built to shake your conviction. This is where patience pays off. Don't chase the green candles. Don't panic dump during the drops. Realize that violent moves in thin markets aren't failure signals. They're symptoms of stress. When the structure is solid, volatility isn't the enemy, leverage is. The final lesson is focus. Tune out the noise. Headlines flip daily. Price whipsaws. Pundits change their stories. What stays constant is behavior. How fast are the dips bought? How does price handle bad news? How little selling shows up during stress? Those are the tells that actually matter. Most importantly, understand your position in the debt supercycle. Late-stage fiat bubbles never pop quietly. They don't top when the herd is fearful. They top when physical silver becomes unobtainium. We are not there yet. This phase is for recognition, exchanging paper for metal and repositioning into hard assets. If you take one thing from this, let it be this. You don't need to predict every paper price tamp. You need to respect the long-term charts, manage your premiums, and let the currency debasement do the heavy lifting. The goal isn't to trade digits. The goal is to hold the metal when the real revaluation unfolds. If this analysis helped you see past the rigors to the real risks, support the channel by liking and subscribing. Share this with stackers who want signal, not noise. Drop a comment below on your favorite round. The next leg up is coming, and having your weight ready always beats panic buying at high premiums.